So thanks very much for coming to this lecture. This is the first in a two-part series on financial markets and market making at IMC. My name is Michael Scott. I've been a trader at IMC for 4 years now. My background was initially in engineering, and I didn't really have any idea about financial markets when I first applied or joined. So hopefully this lecture series will kind of give anyone in that boat a chance to kind of understand what market making is all about and how financial markets work. So as I mentioned, this is the first in a two-part series. Today we're going to be covering what the broad landscape of financial markets kind of looks like, who trades in them, and what they trade. And in the second, we'll kind of talk a bit more about options, which are a specific product class that IMC specializes in. So you can see here we have some learning objectives from today. First, to have an idea what a financial market looks like and who trades in them. Secondly, to understand the role of a market maker in a financial market. Really to understand what IMC does and what you might do at IMC. Next, to understand what an option is and why someone might trade them. And finally, to have an idea what a trader at IMC does and why technical skills are so important. So, without further ado, let's talk about market participants. So at this stage, a financial market might seem kind of overwhelming. There could be any number of things that are a financial market. So for now, let's try and focus down on who trades in a financial market, or the ones that we're interested in at least. So broadly speaking, we can kind of break down market participants into two classes. The first are institutional investors, and the second are retailers. And so the distinction here is really whether or not you're kind of trading on your own as a kind of single person, or if you're going out and trading as a business. And so specifically when we talk about institutions, we're talking about things like banks and market makers and hedge funds who kind of make a business of trading. So to start with, we'll talk briefly about market makers, like IMC. So a market maker is really a market participant who tries to provide liquidity. And so effectively what that means is they try to show the market a price that they're willing to buy and a price that they're willing to sell a given asset. And in doing so, at all times, they can kind of ensure that when someone else comes into the market, they can trade at a fair price. So in particular, you'll find that a lot of exchanges have kind of designated market makers. So these are companies who are kind of obliged to place prices to buy and prices to sell for a given set of products. And so they might receive some payment from the exchange for doing this because they're providing a service to make the other market participants able to trade more easily. A second kind of big market participant that I'm sure you've all heard of are the banks. So banks largely trade in debt, and I'm sure this doesn't come as a huge surprise to you. One of the bank's most kind of natural ways of trading is to basically take on money from a reserve bank, say, and to lend it out to individuals or companies at a different rate. And then they make money by trying to basically lend out money at a higher rate than they borrowed it. But on top of that, a lot of banks have kind of proprietary trading arms. And so they might be able to kind of trade and take a position on certain things. They might try to, for instance, leverage themselves to invest a lot of money into certain stocks or certain sectors, and so on. Another big class of institutional investor are mutual funds, and similarly pension funds. So these are basically funds, which means that they are a company who holds assets. And fundamentally, they basically try and hold long assets. So this is kind of distinct from a lot of other trading where it might be more speculative. They're really trying to invest in the market. So a mutual fund will kind of work to build out its portfolio, buying some set of stocks in some ratio. And on the whole, they're generally looking at much longer time horizons than a lot of other institutional investors might. So you might see a pension fund, for instance, where the expectation is that people are putting in money and they're going to hold it there for 30, 40 years. The goal there is to really have low risk investments that just kind of appreciate over time. And so they're really investing in what they believe is long-term future plays rather than trying to make money super quickly or anything like that. And so what comes with that is this trade-off between risk and payoff. So while the gains may be slow and steady, there's a lot less risk involved. They're not going to go bankrupt overnight or anything like that. And one final market participant who will help to kind of understand the difference between speculation and investing are the hedge funds. So a hedge fund will kind of take on people's money in a very select group of people. So they'll say they'll go and collect money from maybe dozens, 100 people, and then they'll try and invest it in a very speculative way. So they'll basically have one strategy at their core and they'll try and leverage it as hard as they can. And so a lot of hedge funds will kind of make or break in a big way. They'll either make a lot of money or they'll come out with not much. But yeah, and another big distinction here is that the hedge fund is really only catering to a select few investors, whereas a mutual fund or a pension fund will kind of be built on the back of a lot of people. So anyone can go and invest in a mutual fund, for instance, whereas that's not the case for a hedge fund. Finally, we have the retailers. And so these are kind of your mom and pop investors, just anyone on the street who wants to get involved. For the most part, retailers will be trading equities. So you'll hear people talking about their stock portfolios and whatever else. But yeah, on the whole, they're kind of much less sophisticated than institutions as a general rule and trading in much smaller size. So one really interesting distinction between markets across the world is kind of the proportion of traders who are retailers versus institutions. So in a lot of the kind of developing economies, especially around Southeast Asia and that kind of thing, you see much higher participation from retailers. This is kind of broken down a little bit in recent times since the US has gone off the charts with retailer participation, but especially compared to Europe, you'll see much higher institutional flow. And as a result, it can become much harder for another institution to kind of break into those markets. So that's who trades in financial markets. And I guess now a natural question might be, what do they trade? So IMC, for the most part, trades exchange-listed contracts or assets. And so basically what that means is that there's an exchange, say in Korea, there's the KRX, and they will say, we are going to provide you the ability to trade all of these different stocks and whatever else, any different asset that they're interested in. And so IMC's game is basically to go to the exchange and place orders through the exchange and interact with other market participants that way. This is a little different to what some of the other big institutions might do. For instance, banks in particular will be much more heavily involved in over-the-counter trading, we call it, OTC. And here they're basically coming up with really complex assets or much more size than you can comfortably do on the screen market, as we call it, which are the exchange-listed ones. And they'll kind of go and shop out their products to a different bank and try and find the best price that way. So in that sense, it's similar to the hedge fund. You're really catering to a very small kind of potential pool of traders, whereas when IMC places an order, it goes to the exchange, and anyone who is able to trade on that exchange will be able to interact with our markets, basically. So the kind of things that can be traded typically on exchanges are equities. So we have things like stocks and ETFs. Hopefully you're comfortable with stocks. ETFs are just kind of an exchange-traded fund, they call it. So roughly speaking, it's a group of stocks that are supposed to track some number or perform in some way. Another very common thing that people trade is debt. So you'll see people trading bonds and that kind of thing. IMC doesn't do a huge amount of trading in debt. That's really more on the side of the banks. A big class that IMC does trade are the derivatives. And so a derivative very generally is any product that kind of derives its value from some underlying asset. So a very simple derivative, for instance, is a future. And the idea behind a future is that you say, I'm going to trade a futures contract with someone else. So you could literally get a piece of paper. And on that piece of paper, it says, on this day in the future, say in 2 months' time, I will trade whatever this underlying product is at this price against this person. So you can imagine that a lot of participants might be interested in futures contracts, especially on physically delivered things. So the classic example is the soybean farmer or something like that. So say you have a soybean farmer who's producing a bunch of soybeans. As the price of soybeans moves, their kind of profitability will fluctuate. And so one thing they might want to do is to try and stabilize their profitability over the next few years. So say, for instance, they know that they're going to have produced 100 tons of soybeans in 3 months' time. What they can do is, one option is just to hold on to their soybeans in 3 months' time. And then if the price has gone up, that's great for them. If the price goes down, not so good for them. But as an alternative, they could trade a futures contract, where the futures contract would say, in 3 months' time, I'm going to sell 100 tons of soybeans at this given price. And in doing so, they've kind of locked in their exposure to the price of soybean movement. So as long as they still have those soybeans in 3 months' time, they're good to go. Another very important class of derivatives are options, and we'll talk about them in a bit more detail here and again in the second lecture. Options are IMC's most important asset class, basically. Some other interesting things that trade on exchanges are currency pairs. So you can imagine someone might want to trade the USD versus the AUD rate, for instance. So if you think the Australian dollar is going to become stronger, relatively speaking, you might trade a bit of that. And finally, commodities. Commodities are really much more concentrated in the US in terms of the volume and the trading that happens there. But specifically here, we're talking about things that deliver in physical goods. So things like oil or gold or soybeans, as it may be. So very briefly, I'm just going to touch on stocks and indices. So a large part of IMC's trading is in stocks and indices and their corresponding derivatives. So I just wanted to kind of lay out what these were. Roughly speaking, an index is just kind of a theoretical basket of stocks or other assets, typically stocks though. And so what that means is it's kind of a weighted sum of a bunch of different stocks. And so one thing you might hear a lot on the news and whatever else is how various national indices are doing. So you'll hear about the ASX moving some number of points, maybe the Nikkei from Japan or the Kospi from Korea. And yeah, what this roughly means is that there's some kind of combination of stocks that correspond with each of those countries, and they've moved in some way or other. Typically, these indices are defined by the kind of biggest stocks for a given country. So in particular for Kospi in Korea, you'll have things like Samsung making up a very big portion of the index, and they're kind of weighted by how big they are, relatively speaking. There's a few exceptions to that, but for the most part, bigness of a stock is kind of defined as market capitalization, which is the amount of outstanding shares and their value at a given time. So you can imagine that you have this kind of Kospi index, and as Samsung moves up, the Kospi index moves up, and so on. And so another thing that will be really important for options trading is a concept called volatility, which is basically the amount that something is expected to move at a given time. And so one interesting side effect of having an index is that for a given stock, you might have a huge amount of volatility, right? The stock might move 10% up or down on a given day. But once you kind of combine all of these stocks into an index, especially a national index, what you often find is that the volatility of the index is much less than any of the constituent stocks. And the reason for this is that all of these stocks will kind of have interacting correlations. So when one stock goes up, maybe another one goes down. If they're both in this index, then maybe the index will kind of flatline while they move. And so an example of that, for instance, might be if you have one stock in a healthcare kind of sector and one in a defense sector, maybe if defense spending is going up, healthcare spending is going down, and so these kind of stocks will move in a way that counters each other. So while they on their own might be quite volatile, the index as a whole might be a lot more stable. And this plays a big role in options theory for stocks and indices in particular, and valuing those options. So it's also worth noting an index doesn't have to be a national index. It can really be anything you want. And so quite commonly you'll hear about sector indices, for instance. So you might hear about some technology index where all of the biggest technology companies' stocks are basically combined. Cool. So we're going to talk about market making next. And just before we do that, I wanted to lay out some useful terminology. These will kind of become a repeating theme for the next few slides. So try and remember them as best you can. So the first one is an order. And basically an order is when some market participant says, I want to buy or sell some asset at a given price and with a given volume. So they want to trade this much size. So in particular, if IMC goes to the ASX and says, I want to buy 50 Rio Tinto shares at $50, they would be placing an order basically. There are lots of different kinds of orders and they change depending on the exchange you're trading with. But for now, let's kind of imagine that when you place an order, it stays there. If anyone wants to trade against you, they can, until you say, I no longer want to trade that order, basically. We'll make a distinction between bid orders and ask orders. So strictly speaking, these are orders to buy the product for a bid and to sell it for an ask. Sometimes we'll call that an offer as well. The most interesting ones are typically the best bid and ask, we'll call them. And so these refer to the most competitive orders for the given side. So the best bid will be the bid that has the highest price, and the best ask will be the one with the lowest price. So someone says, I'm willing to sell this thing at a lower price than everyone else. That's going to be the first order that trades when someone comes in to buy it. A useful concept for market making will be the bid-ask spread. So this is going to be the difference in price between the best bid and the best ask. And we'll talk about crossing the spread quite a bit, which means someone has kind of come into a market, they've seen that there's a best bid and a best ask, where someone else is saying I'm willing to buy here and sell here, and they've decided that they're willing to trade against that. They'll cross the spread. So they'll sell at the price that someone else is willing to buy, or vice versa. We'll also talk about a book, which is basically all of the outstanding orders in a market at a given time. And a couple more general terms. So liquidity, I may have mentioned a few times already. Liquidity is kind of an abstract idea which captures how easy it is to do a trade, roughly speaking. And so you can kind of think of it as the relative cost of trading. So in a market that's less liquid, you might have to pay a lot more to execute the kind of size that you want to trade. Whereas in a market that's more liquid, it might be a lot cheaper to trade against someone else. This can take a few forms. Either the market might be very wide, in which case it's very expensive to cross the spread, or the market might be up for very little size, in which case you might have to cross the spread repeatedly to get as much size as you want done. And finally, we'll talk about a theoretical. And this is basically shorthand for a theoretical price. So this is some market participant's idea of the value of whatever they're trading. Cool. So let's talk about market making with all of that in mind. So the market maker is basically a market participant who tries to provide liquidity. Sometimes they'll even be called liquidity providers. And so what that effectively means is that at any time, a market maker is providing a bid and an ask. That is a price that they're willing to buy some product and a price that they're willing to sell it at. And so whenever another market participant comes in and says, I'm looking to buy this share or this option, there will hopefully be a market maker keeping the market relatively reasonable. So without a market maker, you can imagine that it's kind of a gamble whether or not someone else wants to do the opposite trade to you. And if they don't, then you might have to go and cross a very big spread to actually execute. Whereas with a market maker in the book, you'll be able to see their bids and their offers, and you won't have to pay as much, basically. So the market maker basically makes money trying to remain relatively risk neutral. And so what I mean by that is that at any one stage, the market maker doesn't want to be taking a position one way or another. They really want to be as flat as possible. So if a stock is moving, you can obviously get exposure to that stock's movement by being long or short the stock. The market maker doesn't want any part of that for a kind of serious amount of size. What they want to do is really capture the bid-ask spread as much as possible. So basically, if they're on the bid and the ask, and then someone comes in and trades both sides against them, they will have captured that spread. They'll have bought at this price, sold at this price, and locked in the money in between. And now they have no more position, so no more risk if the stock does move. So from here, I want to talk about some market making dynamics through a few examples. The first one is going to be a currency exchange counter, like I'm sure you've seen at various airports. And the second is an iPhone kind of thrift shop. So the currency counter example. So when I talk about the currency counter, you might think to yourself, they're not market making, they're not in the big financial markets. But at the end of the day, the currency counter will provide you a price where they're willing to kind of buy your Australian dollars to turn them into US dollars, for instance. And they'll provide a price to sell where they're willing to sell you Australian dollars in return for US dollars. And so as a result, they're really making a market. They have a bid and an ask price, and their goal is to get people to come in and trade against them. That's how they make their money. So yeah, I guess you can imagine you go on a holiday and you have 100 Australian dollars in your pocket, and you're on the way to the US and you realize you can't do much with those Australian dollars. So you go up to the currency counter and you say, I have 100 Australian dollars, how many US dollars will you give me? And roughly what you'll find is that they might say, we'll give you 75 US dollars or something like that. So fine, no problem. You go off on your holiday. Once you're there, you realize that you don't actually need these US dollars. You can use your card or whatever else. And so when you come back, you go back to the currency counter and you say, I have these 75 US dollars. They're no use to me now. How many Australian dollars can I get? And hopefully when you think about this, you don't think that you're going to make 100 Australian dollars back. If that were the case, then the market maker would basically come away with nothing in this case. And so the reality is the market maker will take, maybe they'll give you 90 Australian dollars back. So what happened? You gave them 100 Australian dollars and got 75 US dollars. And then a couple of weeks later, you came back, gave them their 75 US dollars back and got 90 Australian dollars back. And so on the whole, they basically came away with $10. And so that was them capturing the spread, basically. They now have no more risk if the US dollar or Aussie dollar moves relative to each other. They've just kind of locked in that profit. And so that's how the market maker makes money in the general sense. So one thing that can be interesting to think about in terms of market making dynamics is what happens when they make that spread really, really wide. That is, you go to them and you say, I have 100 Australian dollars. How many US dollars can I have? And they say, you can have 50. And then on the way back, you say, here's 50 US dollars. And they say, we'll give you 50 Australian dollars or something. So obviously for them, if they do capture that spread, that's great. They've come away with $50 instead of 10. But market making kind of gets squeezed very quickly as competitors come into the market. So if someone was the only market maker, say this currency counter, and they were extremely wide, then someone else could come in and just create a slightly tighter market. And in doing so, they could take all of the market share off of that initial currency counter. So the market maker's in this kind of constant battle between trying to keep reasonable spreads while ensuring that they're competitive with everyone else. So much like other businesses, you're kind of trying to maximize the amount of profit you capture while also the amount of per volume and also the amount of volume that you trade. And so that's really a big part of market making dynamics. And so I guess you might be sitting there thinking, how can the market maker lose money here, right? They've gone and made their 10 Aussie dollars every time someone comes in and out. And yes, that's true, on the condition that someone does come back the other way. And so one thing that's really important for market makers is, as I mentioned before, trying to stay risk neutral. So you can imagine in those 2 weeks where you were off in the US, the market maker actually had exposure, right? They initially had US dollars and they gave them up. Now, if those US dollars become worth significantly more relative to the Australian dollars that they took on, the market maker will be losing money until someone comes back the other way. And so one thing you can imagine is that on the whole, the market maker needs to have a really good idea of what something is worth. If they get it wrong and they're constantly trying to provide liquidity for the market, everyone else could just come in and trade against them in one direction. And then once the market's kind of corrected itself and the market maker says, okay, I now realize that this is the price, and they've corrected their price, everyone could come and trade against them the other way. And so a market maker can lose a lot of money by having an incorrect theoretical or by taking on more risk than they can handle at any given time. So let's talk about the second example, and that is this iPhone thrift shop. And so you might have seen a few of these around where someone basically has a sign out the front and they say, you know, we will buy your old phones, we'll sell your old phones as well, I guess. And so, yeah, you can imagine that here they are basically acting as a market maker. They've said, here's a price that I'm willing to buy an old phone at, here's a price I'm willing to sell a phone at. And so in doing so, to basically figure out where that bid and ask should be, the shop's basically going to have some idea of what an iPhone is worth. And so you can imagine this is their theoretical, basically. So they've got some mathematical model that takes in a whole bunch of factors and spits out this is the price of a given iPhone. And that's not dissimilar to what the market maker does, basically. So in this case, say the market maker, the thrift shop has a valuation of an iPhone at $200, and they put a sign out the front that says, we'll buy iPhones for $175 and we'll sell them for $225. So similar to the currency counter, if someone does come in and sells them an iPhone and then someone else comes in and buys an iPhone from them, they've done great, right? They've captured that $50 spread between the bid and the ask, and they're off. They have no more risk anymore. But let's have a think about what happens if that's not the case. So someone might come into the shop, see $175 that they're willing to buy an iPhone for, and say, okay, I'm willing to sell at that price. So say on one day, a couple people come in and sell iPhones. On the next day, maybe a couple more people come and sell two more iPhones to them, and so on and so forth. And you can imagine that after kind of 10 days of this maybe, this shop now has 20 iPhones and no one has come in looking to buy an iPhone off of them. So, you know, the manager of the shop comes up to the salesman and says, what are you doing? You're here to make money, not iPhones. But at the end of the day, they've kind of come away with a bunch of premium locked into these iPhones and nothing. And the salesman might say, these are great trades. You don't understand. These things are worth $200 and I bought each of them at $175. But the reality is that profit is theoretical. Until you're able to sell that iPhone at the price that you want, you haven't locked in anything. And so that's very similar to a common market making concern. If you've got a big price, but a big position, but your theoretical is wrong, you don't actually know how much P&L you've made until you're able to lock it all in. So one thing that would be quite common then, if you've come and bought a bunch of iPhones at $175, say, you might start to question your theoretical. So if day on day on day, everyone's come in and sold to you, you might say, well, it doesn't seem as though the market values these iPhones as highly as I do, right? Everyone's looking to sell them, no one's looking to buy them at my price. And so what a market maker will commonly do is trade and adjust. This is kind of a very common paradigm where the idea is as you trade, you kind of say, okay, the market has given me some information about their theoretical. And as a result, I'm going to move my theoretical in line with that. So as I've kind of got longer and longer iPhones, I might say, okay, I need to move my price down a little bit. So instead of valuing these things at 200, I might start valuing them at 190. And then I go and change the sign outside. I'm willing to buy at 165, willing to sell at 215. So I might still be capturing the same spread, but as people start crossing into my offer, that is buying iPhones off of me at 215, I might start moving that back again. And so you can imagine if I've bought these at 175 and sold at 215, I might still be capturing a lot of money and a really great spread, but it's less than I initially thought I was going to get. So one really important kind of feature of a market making setup is how much you adjust. That is how willing you are to kind of hold on to inventory and believe in your theoretical versus how likely you are to move it away from yourself. So you can imagine if the market maker said, I've got all this inventory and I want to adjust a huge amount. So if they moved their theoretical from 200 down to 100, now all of a sudden they might say, I'm willing to sell at 125. Well, if the market just says, okay, I'll buy at that level, then all of a sudden you've kind of bought 175, sold 125, and come away with negative money. So there's kind of a fine balance between adjusting enough to get yourself out of this position that you don't want and to lock in a spread, while avoiding the capacity to over adjust and lock in a negative trade, basically. And so one other thing that we can think about is the dynamics of having a bid-ask spread that's too tight or too wide. So in particular, in this case, if you think about the thrift shop who has no interest in kind of holding too many iPhones or anything like that, if they do make their spread too tight, so say they come in with a theoretical of 200 and they say, I'm willing to buy at 199 and sell at 201, they might get a lot of business, right? Everyone with any interest in buying or selling an iPhone will probably say, that's a great price, I'm willing to do it. So maybe they get 100 iPhones sold, 100 iPhones bought, and they come away having made $2 100 times. That's great. But now you can imagine the case where their theoretical isn't so great. So say they think it's worth $200, all of a sudden overnight, Apple announces that they're releasing a new iPhone, and all of a sudden the value of these old iPhones plummets. Everyone's looking to buy the new one, no one has any interest in this old one. So if you sit there as a market maker and say, I'm willing to buy at 199 and sell at 201, but the rest of the market's theoretical is kind of updated down to 150, say, you can imagine you're going to trade very massively in one direction. And so you'll end up with nothing but long iPhones, basically. And so while you may have captured a lot of spreads when the going was good, as soon as your theoretical got out of line, you may have lost a lot of money. Conversely, you can obviously make the market too wide. If they come in and say, we'll buy iPhones for $50 and sell them for $350, maybe no one trades against them. So if they do end up getting any buys or any sells, there's a pretty good chance they're good. But the reality is no one's going to give them or buy an iPhone off of them at those kind of levels. So again, you can see how the market maker's goal is really to kind of optimize the level at which the market is willing to buy and sell from them. If you can find a theoretical that kind of selects that level and then make your spreads wide enough that people are willing to trade without undue risk, if you do get it wrong, then all of a sudden you can make the most amount of money. So, as I mentioned earlier on, IMC is first and foremost an options market maker. And so we also mentioned what a derivative was earlier on. That is a product that derives its value from some underlying contract, underlying asset. And here, an option is another kind of derivative. So specifically, an option is a contract, and that's why you can see on the right, there's kind of a piece of paper with some details on it. And that contract gives the holder the right to buy some underlying asset at a given price at or before a given date in the future. So this sounds quite complicated. We'll break it down a little bit. So you can imagine there's kind of two kinds of options. So the first one is the call option, which basically gives the holder the right to buy the underlying asset. And the second is the put option that gives the holder the right to sell that asset. For now, we'll focus on calls just for simplicity, but they are very similar in their dynamics, basically. So one thing you might think about with an option is kind of how much it's worth. And one kind of very basic building block of options is that they are worth a positive amount of money. And that's because an option gives you something called optionality. That is, when you come to expiry, that is the final day where you can decide if you want to buy this underlying asset at the price. You have the option to kind of buy it or not. And in doing so, that optionality is hopefully clearly worth something. If you decide not to do it, you're kind of no worse off. If you decide to exercise your right, that is to buy the underlying asset, then hopefully you've managed to buy something that's worth X dollars at some price less than X. And so that in itself, that optionality is worth money. So let's very briefly talk about this contract on the right-hand side of the screens. So here we've got a Rio Tinto December 95 strike call. And so this option right here would basically say whoever holds this has the right to buy Rio Tinto shares. Options generally have some contract size which says how many shares you can trade for one option. And we'll say that's 100. And so that's kind of our that's the underlying asset, which we'll describe with a value of S. So Rio Tinto right now is worth S dollars. Then we see there's the kind of expiry term. So you can see it's at or before the 18th of December, 2020. And so this is a time that we call expiry or maturity. And so basically whoever holds this option has to have decided whether or not they're going to exercise their right to buy at or before that date. And finally, we have the strike price. So that's X here. And this is the price that they will be buying at in the future if they want to exercise their right. So very briefly, let's talk about the kind of value of an option. And so a big part of market making is obviously having a good theoretical. And to that end, we need to know what a given option is worth. So here we can see what we'll call a payoff diagram. And that's basically if you hold this option at expiry and then exercise it in a reasonable way, that is, if the price of the stock is higher than the strike price, you do exercise your right. So instead of saying, you know, Rio Tinto is trading at 105, I've got an option striked at 95, then you say, I will buy that at $95 because you can immediately go and sell it to the market for 105. Good trade. So on expiry, the value of an option basically has this cusp-like feature where if the strike is any higher than the value of Rio Tinto, it becomes worth zero. You don't exercise that option. And then for every dollar that the share is above the strike price, you make $1, basically. So hopefully you can see that in the example here, if Rio Tinto is trading at 100 and we have the 95 strike call, its value on the y-axis here is $5. So that's all well and good. We can figure out how to price an option on expiry, but that doesn't do IMC a huge amount of good. So typically options trade not on expiry date, but rather when they're expiring in several days, months, even years' time. And so IMC's job is to basically create a valuation for those options. I won't go into too much detail here because there will be a lot more detail on this in the second lecture series. But here we can kind of see that if the green line is the value at expiry, the purple line kind of captures the value of an option in the lead up to expiry. So this might be 10 days from expiry, and then as the strike price changes, the value of the option will change. And so as I mentioned before, optionality is worth something. If it comes to expiry, you can say, I'm going to exercise my right or not, so you can always make money or zero on that. And so you can see even the very far sides of this chart, so when the strike price is, when the spot is very, very low, the option will have a little bit of value, right? If you buy the 95 striked option and the underlying is worth $50, there is still a chance that it ends up worth more than 95. So you have to pay a little bit of premium. One thing that we'll kind of see in the next slide is that an option's value can kind of be broken down into two components. The first is what we call the intrinsic value, and that's what this green line tries to capture. And the second line is the time value, and that's kind of the difference between the purple and the green line here. So let's talk about that. So the intrinsic value of an option is just the difference between its strike price and the current underlying price of that asset. So you can imagine this is roughly the value of an option at expiry, just as we had before with that cusp and all. So now the time value, on the other hand, depends on a lot of things. So quite naturally, you can imagine that it depends on how long you have until expiry. If you have an option that expires in 6 months' time versus one that expires in 1 day, you might say in 1 day, there's only so much a stock can move, but in 6 months, it can move a lot, right? And so if the stock's going to move a lot, then your option is going to be worth more. That optionality has a bigger chance of becoming worth more over the course of 6 months. So the option will be trading at a higher level, basically. Another interesting feature of time value is volatility. So this is a really important in pricing options, and it basically tries to capture how much the underlying asset is going to move on some given scale. And so again, you can imagine if the volatility in a given stock is extremely high, then there's a much better chance that an option will become worth something if it was initially worth zero, effectively. So if the stock is able to move much, much further in a short time frame, then your option, which may have been $50 away from becoming worth something at expiry, may now be more likely to become worth something. So the volatility will kind of influence the price of that option. Lastly, we have dividends and interest rates. I won't go into too much detail here. They're quite complicated and for the most part, not terribly interesting. But yeah, I want to briefly, so I guess here you can see that we have the value of an option is kind of some function of the underlying price, the strike price, the volatility, which is sigma here, the rates, which is R, the time to expiry or maturity, which is this T here, and then the dividends, which are captured by D. And so assuming we have some model that takes in those inputs and outputs some value, I want to talk a little bit about how we can calculate these parameters, because this is a lot of what the market maker at IMC does. So a lot of these things are kind of just given to you. They're in the nature of the contract. So in particular, the strike price and the time to maturity are fairly well known. In some cases, dividends and interest rates will be as well. That's not always the case, but let's assume that they are for now. And so I guess that leaves us with two kind of interesting inputs to the option valuation. So the first is the underlying price, so this S, and the second is the volatility. So that's the sigma there. And so there's a lot of ways that we might be able to estimate these things. And so I guess in particular, you might look at if you're in a kind of different kind of institutional trading environment, you might spend a lot of your time trying to figure out from the fundamentals what a given thing is worth. So maybe you say, I've looked at kind of all of the annual reports for this stock, for this company, and I've kind of built up some idea of where they're heading, and I think this is what this stock is worth right now. And so you can imagine you could do all of that and come out with a spot price. That is the underlying asset value. In a similar way, you might be able to look at kind of correlated stocks or options and say, if this stock moves in this way, then I expect this other stock to move in a similar way, because they're both auto manufacturers or whatever it may be. And so a lot of the time you can kind of influence the price of one stock by taking in information from another one. That might seem a little circular at this stage where we don't have an initial price for each stock, but hopefully that will become clear soon. On the other hand, we might need to estimate the volatility of a stock. And so, as I've mentioned, this is kind of trying to capture how much a stock moves over time. And so you might be able to say, take a bunch of historical data and try to pin down what we'll call historical realized volatility. So that is, you look at how much the stock has moved over the past, kind of do a quick transform, and then you have some value for what the volatility of a stock might be in the future. This is obviously quite prone to error. Like, there's no guarantee that a stock's movement over the last 6 weeks, 6 years, whatever it may be, influence its movement over the next few weeks or until expiry. But on the whole, it's quite an interesting metric and can be very useful in determining pricing. But you can also imagine a lot of cases where that would go wrong. So say, for instance, there's some big earnings event coming out for a stock. Samsung's about to release their Q2 earnings or a new phone or something. If in the period that you're looking at their volatility historically, there's none of those events, you might have no concept for the amount the stock can move on the back of news like that. Finally, and this is where IMC does most of its work, is trying to understand where the market is trading. So you can imagine that we see a lot of market data. There's a lot of information in where people have placed their orders. And from that, we can try and infer where the rest of the market thinks the spot price is and the volatility for a given option series. And so again, if you think back to the role of the market maker and what their goal is, it's really to find the valuation which maximizes the amount of buying and selling that they can interact with. If you can interact with similar but equal amounts of buyers and sellers, then you've captured as many spreads as possible. And so this makes a lot of, in that sense, using where the market is trading as information in your pricing makes a lot of sense. If you can say, I believe that the market is kind of evenly trading around $100, then you can hopefully leverage that as your pricing and capture as many buyers as sellers, and therefore capture the spread as well as possible. And just to go a little bit further on that, let's have a look at an order book. So I mentioned before the idea of a book, which is basically all of the outstanding buy and sell orders in the market. Here we have a very simple representation of that. So say there's 4 different possible bid levels and 4 ask levels. And at the 99.99 level, there's an 100 lot bid. And at the 100.01, there's a 100 lot offer. And so you can see from this simple table that we kind of have a representation of the market's supply and demand at a given point in time. So at any one point, we can kind of snapshot where all of the buy and sell orders are and say, okay, this is how much supply there is, this is how much demand there is, and use that to kind of inform our pricing to find that balance point where we can maximize our interaction with supply forces and demand forces. So this is a very simple breakdown of it, but hopefully you can imagine that you can incorporate a lot of different information into a simple algorithm to kind of build up your valuation, just from market data, that is. So if you had to look at this order book on the screen right now, you'd probably say, I think the thing's worth $100. What you could almost definitely say is it's between 99.99 and 100.01. That seems pretty fair. But on average, you'd probably say there's equal size on both sides, therefore I'll just split them down the middle. And so that in itself is a very basic valuation algorithm. There's a lot more information though that comes from the market. So you might see a sequence of books basically. So you might find out that people have just been pulling a lot of orders off of the bid, for instance, and maybe that biases you to say, maybe the value of this thing isn't 100, maybe it's closer to 99.99 or something like that. maybe there's been a bunch of trading on the bid, so someone has been aggressively selling. That might tell you the same thing. And so on the whole, what you can kind of see is that we don't get a clean representation of the value of the underlying. We really have to build that up. And similarly, we don't get a clean representation of the value of volatility for the options. But what we can do is kind of put together all of this market information and try and build up some idea of what the underlying asset is worth and then what the volatility is worth. So, hopefully that's been an interesting introduction to financial markets and options market making as a whole. For now, I just wanted to quickly touch on the kind of what makes a trader good at IMC and what kind of people we tend to look for. So on the whole, traders at IMC are quite technical. Hopefully you can see from some of the above why that might be the case. There's quite a bit of maths going on, a lot of algorithm development, especially in coming up with valuation and that kind of thing. And so largely we look for degrees with STEM backgrounds, as well as more financially focused people, so actuaries, finance, economics, that kind of thing. We really are looking for people who are avid problem solvers and are very competitive. If you want to win in a team environment, that's the way to go, basically, because really market making is a big competition. We're also looking for people who are comfortable with uncertainty. In trading, there's a lot of times where you have to make snap decisions, and in large part, you are working with uncertainty. At any given time, for instance, we might see an order book, but who knows where the rest of the market's actual interest is. Maybe someone has a very different idea and wants to trade in one direction. We don't know that, and so we have to be able to make snap decisions to react to that. And finally, passion for financial markets is really fantastic. As I mentioned, when I joined, I had no financial literacy whatsoever, didn't know what a financial market was. So no prior knowledge is required. There's a really good training program that will bring everyone up to speed, but definitely an interest in these kinds of things and this great competition is super important. So thank you very much for coming to this lecture. I think there'll be a Q&A afterwards, so feel free to stick around for that. And definitely stay tuned for the second lecture in a few weeks on options theory. Thank you.